Hi, Valerie Leonard here with Grinkmeyer Leonard Financial. And today I want to share my thoughts with you about some key metrics that I'm watching closely so that you can better understand what's happening in the market and in the economy and gain some perspective on the outlook ahead. Today, I want to help you answer three questions. Number one, what is it that I need to know? What is the stock market telling us? And what might we expect going forward? There's obviously a lot going on in the world around us. And first off, I want you to know that our award-winning team here at Grinkmeyer Leonard Financial is here for you. So you may be an existing client wanting to know more about our thoughts on the market going forward, or maybe you're an employee who's a participant in a retirement plan managed by our team, or maybe somebody has shared this video with you and you're here today thinking about your future. But please know that our mission is to help you make the most of your money and your time. So if there's anything that we can be doing for you, please reach out or subscribe to our channel to follow us in the future and get updates when new content is available. So, recent market volatility has beat up a lot of day traders and newbie investors who have been getting their shirts handed to them over the past week or so. And I want to remind everybody that it is easy to make money when markets are good, but it's hard to keep from losing money when we see lots of volatility. And so you can't ever lose sight of your downside risk. So this is where you absolutely, positively have to have a process when you invest. I am watching this market very closely on behalf of our clients, and I'm extremely aware of what's driving these ups and downs. And I can tell you after nearly 2 decades of doing this, risk management is everything. I'm constantly thinking about how much risk my clients need to take, how much they want to take, and managing their investments with that in mind. And you need to do the same thing because there's a lot going on. So let's talk about that. There have been 11 new stock market highs in 2021. That is right. In 4.5 months, we have seen lots of new highs. And there's been a lot of money that has been made. But there's also a number of things happening out there that investors aren't necessarily aware of. So as a matter of fact, if you go back over that same 4.5 month time period, there has been at least 6, actually more than that, but at least 6 major crises that have happened over that same 4.5 month period. So in January, investors who had been betting against the market were forced to cover their high interest short positions. And in February, we saw big hedge funds who had to sell a lot of their large mega cap positions. Then we started to see SPACs garner a lot of attention. If you don't know what a SPAC is, it's basically a company that exists for the sole purpose of raising enough capital on the open market to buy out an existing company. And they're often highly speculative. So these things became wildly popular back in 2020. 2019. And it turns out many of these SPACs brought a lot of junk to the market, and investors still don't know what they own in many cases when they own these things. But anyways, March brought with it a rise in bond yields, which spooked investors in general, and it caused big fund managers to take action. And then in April, concerns were raised over small cap companies, and we've even seen a few hedge fund blow-ups. So lots has been happening. But let's start by looking at some of the most important economic metrics that help us determine where we are now and possibly where we may be headed. So first off, consumer confidence improved for the 4th month in a row, and by more than expected in April, when the index rose to its highest level since initial lockdowns began last year. And confidence is actually back to pre-pandemic levels. So it's going to be important to watch the jobs market and whether vaccinations will continue to allow Americans to get back to work. Don't forget that 70% of our nation's GDP is derived from the amount of money that you and I put back into the economy. And it's going to be important to watch the unemployment rate and how quickly jobs come back. And speaking of jobs, April's employment report showed that we are continuing to add jobs, especially in the areas hit the hardest by the pandemic. So think hospitality, travel, leisure, restaurants, those areas. But the pace at which jobs were added in April was pretty disappointing. We saw a slight uptick in the unemployment rate in April, which now sits at 6.1%. And one area that's been pushing markets higher has been stronger earnings reports from corporate America. So we've seen about 86% of companies as of yesterday, May 12th, who had reported. And we've seen so far companies beat their earnings estimates. And this is the strongest earnings season that we have had really in the past decade, at least. So financial companies have led the charge with those favorable earnings reports. Many of the big banks are doing really well. Technology has also remained strong, and then that's been followed by communications and then consumer discretionary type companies. So these are the companies who offer products and services that are considered non-essential, but a lot of their products and services are really in demand by consumers when they can afford to buy them. So discretionary type things. And I expect that this trend will probably continue and earnings will be strong for the next quarter. And then another area that I like to watch is the health of the service sector in general. So service sector confidence has rebounded, and we're expecting continued growth in this area, especially since we're seeing state and local restrictions ease a bit. But we're already at pre-pandemic levels for the service sector confidence index, which signals further expansion is possible. And then it's worth noting that the rest of the globe is still recovering. So countries who have successfully rolled out vaccines have been reopening most quickly, but countries like India, for instance, are falling behind with dealing with the realities of COVID and the additional waves that they've experienced. They're putting new lockdowns in place and more economic damage is happening. So this proves that the risks are still very real, and we have to pay attention to deteriorating conditions elsewhere. But as we see inoculation rates improve for other countries out there, I think that there's lots of growth outside of the United States potentially that we could see in the future. So we're also keeping an eye on inflation. I've mentioned this in past videos. So keep in mind that our Federal Reserve is tasked with keeping inflation in check and providing liquidity for our financial markets and making sure that the world is confident in America's financial stability. I personally am very concerned about rising prices. Just this week, we've seen headline inflation rise by 4.2% from a year ago. Much of this has been driven by supply chain concerns as we've had shortages in maybe semiconductors or raw materials and things like shipping containers. And I even saw yesterday Chick-fil-A sauce is now now being hard to get. But it's no secret that prices are rising. And, when you look at commodities, corn, copper, lumber, companies like Procter & Gamble, Kimberly-Clark, Coca-Cola, they're all warning that price increases are coming. And at the same time, the Fed is acting in a way that is creating dependency. So I feel like, they're enabling our greed, they're eroding our purchasing power, and they're forcing us to take pause and ask the question, will the U.S. ever be in a position to allow deflation? We've gotten used to prices where they are, and nobody wants to see their home values decrease. Once you're hooked on easy and cheap money, it's going to be really difficult to go backwards. So, the other thing we have to consider is, what does this mean for quality standards? Since people can't simply afford higher prices in all cases, I think companies are being forced to rebrand their products under different names, and they're offering lower quality products at the same low prices in some cases. And then let's not forget about Biden's infrastructure bill, which is creating a rotation from growth stocks to value stocks. And so, when you think about his tax plan, the companies that stand to benefit the most are the construction industry, suppliers, domestic manufacturing, green energy, that sort of thing. So in the grand scheme of things, you should expect more volatility for your portfolio. And let's not forget, Bitcoin has been top of mind for most investors. I'm sure you've heard of it. I refer to it as Bitcoin mania, which feels to me as a professional money manager a lot like the .com bubble, but that remains to be seen. So let's take a look at the stock market. This is a chart of the S&P 500, and this goes back basically 2 years. So you can see, of course, from May of 2019 up until February of 2020, markets were moving higher. We saw the dip back in March of last year, and then the subsequent recovery since then. And of course, there's been periods of time where we've had significant volatility. We've seen some big dips, but overall, the market trend has been higher, which is positive. And then just this week, you can see here kind of in this far right-hand side, the dip that we have taken where we have pulled back to the 50-day moving average on the S&P 500. Now, the other thing that we're dealing with is a tech correction. So technology, of course, I've said many times, has given this market legs to stand on coming out of the pandemic. And you can see, of course, just going back to, this is actually a 10-year chart, okay? So this goes back even further. Technology has been a great place to be, but when it corrects, you see major sell-offs. So think back to, this is 2015, this is back in the end of 2018. Of course, the pandemic, we've had volatility, at the end of last year, and then most recently, more volatility kind of in this area. So when technology corrects, the dips can feel painful, but overall, the trend is still intact. And that, seems to indicate that unless we have a catalyst or some major event that derails technology or our economy or world in general, technology still seems to be trending higher. So let's talk about going forward. Just in general, some things you need to know about what you can expect and how you should be thinking about your investment portfolio going forward. Of course, stocks historically have been a great hedge against inflation because stocks generally move up at a faster pace than prices in general. So that's something to keep in mind. The bond market can be one of the hardest and trickiest places to be when you have inflationary periods. But overall, regardless of what type of investor you are, you need to expect volatility. If you're going to play the game, just understand that sometimes the down days can be bigger than they have been in the past. And that's just simply because we are in a high growth environment. And when you see high growth, that means that big returns often, will retrace in a big way in a short period of time. So my advice to you is never take more risk than you're comfortable taking. A lot of investors right now are considering what we call a core and a satellite approach. So if you're hearing about stocks that you get excited about, or maybe you're thinking about some of the areas that your friends are talking about, what you need to do is consider making the core portion of your portfolio really solid. So you design that with your long-term goals in mind. You think about risk management. And then if you do want to speculate, or if you are willing to take more risk, maybe you do that with a smaller portion of your portfolio. So we call that a core and satellite approach. And that's where you kind of overweight certain areas of the portfolio to take a little bit more risk. But overall, you want to keep your overall risk level in check. Also ask yourself, what sectors stand to benefit from current conditions? And in the end, stay diversified, okay? You want to make sure that you have exposure to different types of asset classes, because investors historically invest with emotions and guess wrong and time the market wrong. And so having a diversified portfolio can help take some of the sting out of the down days. And also don't become overconfident. Just because you've had a good run recently, don't feel like you are always going to be in that position, because I've seen it all too many times. When you've invested as long as I have, you can understand how big and how bad those volatile periods can be and how long they can last. And so you don't want to invest with your emotions, which is why having a process is extremely important. And then the final thing that I ask myself every morning when I wake up, despite my experience as a professional money manager, is what am I missing? There's always something that you could be missing, and you want to constantly be second guessing yourself. That's what great risk managers do, in my opinion. And so always be evaluating your risk. I hope you have found this information to be helpful. If you have questions, if you want to learn more about our company and how we help our clients, or if you have questions about your retirement plan, feel free to reach out to us. You can also click on the link below to schedule an appointment with a member of our team, or to take a risk assessment that will help you figure out how much risk you need to take. It will help you figure out how much risk you're comfortable taking and whether or not your investments are in line with your goals. I hope to see you soon next month. Stay tuned for another video, and thanks for your time today.